Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. The next 20 odd minutes, we'll be talking about ideally one key aspect of debt mutual fund investing, and which is what should the positioning of investors be over 2022 and 2023 if indeed the belief is that interest rates are likely to be on the way higher. And that is something that a lot of you have asked me on various mutual fund shows as well as on Twitter. And towards the end of 2021, from a timing perspective, it couldn't have gotten any better. Two gentlemen with whom I have had maybe a bit of a similar discussion, if my memory serves me correct, and who I believe are well adapted to tell us about what are their thoughts, join me right now on the show to talk about this very thing. Mr. Sandeep Bagla, CEO of Trust MF, and Kirtan Shah. He's been on the show a number of times, needs no introduction. Gentlemen, both of you, thank you so much for joining me.
Thank you for having us on the show.
Pleasure is ours. Mr. Bagla, can I start off with you? What's your sense? If the hypothesis is that rates are on the way higher, how should an investor, she or he, alter her or his debt investment strategy?
So that's a good question because, when we say rates are higher, on their way higher, it could mean that one part of the yield curve could go higher than the others. And as we all understand that if yields go up, interest rates go up, bond prices fall, thereby impacting adversely the return of the investor in the mutual fund scheme that he's invested. So, it's quite possible that the shorter end of the yield curve goes up faster than the longer end, but it's likely to be that the entire curve will rise. So whichever part that you are in, you are likely to experience slightly lower returns. So, typically the hypothesis would be that, go into liquid funds so that there is no impact. But the problem is that in liquid fund, you get only close to 3/4, between 3 and 3.5%. If you were to increase your duration by another 2 years, let's say go into 2-year, 2.5-year maturity kind of a bond, or what we call roll down structures. For example, a corporate bond fund, which has a 2.5-year maturity, which is yielding 5.5%, or a banking and PSU debt fund, which is yielding 5.5% with 2.5-year maturity, you will get substantially higher than liquid fund returns, almost 2.5% higher. And you could, since the investments will roll down, which means the maturity will keep coming down with time, the interest rate risk will not be very high. So even if interest rates go up, your returns will not be impacted. So the idea is basically to not earn great returns. One cannot expect great returns when interest rates are going up. Markets are on the verge of repricing themselves. So just like equity markets are repricing them from a situation where they were building in probabilities of growth and very easy monetary policy all over the world, even bond markets are repricing in an adverse way where you expect higher inflation, higher rates. So it's difficult to say which part of the curve will do better, but I think the roll down maturity funds of up to 2-3 years and let's say liquid money market fund should be all right.
Viewers, if all of you understood this entire answer, then we can wrap up the show, because this is the synopsis really of what you should be doing. But let's try and simplify this further and take it step by step. But Mr. Bagla, thank you so much for explaining in such a lucid fashion what an investor ideally should be doing. Kirtan, can I bring you in this conversation? Let's get step by step. What would happen typically to an average investor if she is holding current funds and if rates were to go up? How do the NAVs get impacted? I'm presuming they get impacted negatively. Why so? And what's the resultant impact? How much deviation does it come? Is there a way to explain that?
So Neeraj, first, thank you so much for having me on the show. So Neeraj, typically, like Mr. Bagla already explained, what happens is when the yields go up, you would typically see that the NAVs of the bond funds would fall. The simple logic or explanation to this is taking an analogy. Let's say today, if you want to invest in a fixed deposit, which pays you 5%, you invest in that fixed deposit and lock yourself in for 3 years. Let's say rates go up tomorrow, right? Tomorrow, the same fixed deposit pays you 5.5%, 6.5% because the rates have gone up. you still locked yourself in for a 5% for 3 years. So while everybody else in the market on the same risk product is going to make 5.5, 6, 6.5 because rates have gone up, and you are still making 5, so the product that you hold will fall in value. That is exactly what happens when rates go up. So when rates go up, like I explained, 5.5, 6, 6.5, and if you're still holding the 5% product, like I just explained to you, the value of the 5% product drops. And which is why it is said that when interest rates go up, bonds or mutual funds are negatively impacted. Now, explanation to this is very simple. Let's say 2 examples. I have a fixed deposit for 6 months, and let's say I have a fixed deposit for 5 years. Now, what will get impacted more and less? The answer to this is very simple. So if I have a 6 months fixed deposit, right, which I hold for 5%, let's say hypothetically, right, my maturity is going to be at the end of the 6th month, right? So if I get my money back at the end of the 6th month, I can reinvest it at a higher rate, which prevails in the market. And hence the loss of opportunity for me is only for 6 months. So when rates go up, this product, which is going to get redeployed again, will fall slightly less, right? It's because you know that the maturity is very close by and you will be able to redeploy it at a higher rate in the market. But the 5-year fixed deposit that I'm holding would probably react more on the downside, is because you've locked yourself in for a longer period of time and you are not going to be able to reinvest the principal anytime soon. And hence the rise in interest rate will impact the 5-year far more than the rise will impact the 6 month. Of course, I don't want to get into the technicality of how a modified duration will come into picture with rise in rates, but largely this is how it impacts, where you are saying that when interest rates go up, or let's say yields go up like the markets call it, the product which has lower average maturity or modified duration, whichever way you want to put that as, would react less on the negative side. And the product which has higher average maturity or modified duration will react more, right? Because of what I just explained to you, Neeraj.
Sure. Mr. Bagla, you want to add something to this? Then I would want to take it down to the other parameters that you mentioned. Yours is the all-encompassing answer, and we're now trying to take it piecemeal, sir.
So what Kirtan said is correct, that if interest rates go up, another way of looking at it is that if you were to lock in to a certain interest rates today, and if interest rates were to go up tomorrow morning, it is the opportunity cost that you have lost of investing tomorrow rather than today. So that's another way of looking at it, that if you invest at a 5% FD today, and tomorrow, for whatever reasons, rates go up to 7%, then you have lost that opportunity of investing at 7%.
Right. So, Mr. Bagla and Kirtan, to both of you, 2 questions. First is from a perspective of an investor who currently has debt mutual fund products across various maturities. It will be impossible to pick it out for all the maturities, but pick up 2 or 3 time durations, if you will, Mr. Bagla. And if she wants to know, what does she do with her current investments, considering that she also believes, like many people, that rates are on their way up? Mr. Bagla, I'll start with you first.
So, there's a couple of things that have become popular in the past. I have seen bond funds having rolled down maturities of 10 years or 7 years or 5 years. That have become quite popular. And I feel that, in our markets now, the cycles are becoming far shorter than what they used to be. So, you would probably see in 5 years very low interest rates as well as very high interest rates. Probably, I hope not, but it's quite possible. It has been happening in the past. So in my mind, that at a time when, overnight rates are at 3/4, locking in yourself with the objective that you are going to invest for 10 years is perhaps a stretch, because you might need the money in less than 10 years, at which point of time interest rates might have risen and your mark to market would not be favorable for you. So if you are trying to match the requirement of your money and the fund that you are investing in, which is a roll down fund, then you should do it wisely and you should not think of taking out the money before. So that was one point, that do not go into roll down schemes more than 3 years, because in 3 years, in 1 year, if interest rates go up also, because the maturity has come down to 2 years, the interest rate impact will be low. And hence your NAV is not likely to change much. The other I would say is that, of course, most of the money that I see today in mutual fund schemes has rolled down to, has now moved to below 3 years. So most of the money is not lying in long-term G-Secs or long-term income funds. Another asset category which I would feel is a bit of a iffy is the floating rate kind of a bond fund. Now, floating rate bond fund typically, suggests that if interest rates go up, they should benefit, which is hardly the case, which never really happens. The investors get locked into a spread in a bond, which can increase, has the same impact as interest rates going up. So, in my mind, the best floating rate fund is the liquid fund, which rolls up, and your interest rates go up, keep going up. So I think that the funds to avoid, I would say immediately, is credit funds, floater funds, and long-term roll-on funds. And I would leave the recommending to Kirtan, because it's his forte.
For sure. Well, Kirtan, actually, the first part of my question is the same one that I asked Mr. Bagla. Here's an investor who is listening to us, and she wants to know, what does she do with her existing investments, which are in the debt products. The maturities may be slightly far out, maybe slightly near as well. What does she do? If the hypothesis is that rates are higher, yeah.
Neeraj, very honestly, in my opinion, investors, unless their goal is close by, should not do anything. I am of a very firm belief that at the retail investor category, I don't really see a reason why most investors will really be able to time equities and more precisely debt really well. So if your goal is not nearby, don't do anything. I'll tell you why. Because in a lot of these funds, unlike equity, liquidity has always been a problem. Rates moving up because of whatever globally has been happening or India has been happening, that M2M impact has already got accounted in the near term in the fund. Now, if you were to get out of it, you are actually booking the notional M2M loss and making it a permanent loss for you. Also, debt, in the debt category, taxation is an extremely important data point that you should definitely consider. Because if your investment is anything less than 3 years versus more than 3 years, the differential tax is extremely high, right? So if I'm in a 30% tax bracket, I will end up paying 30% if my investment is less than 3 years. And if I stay invested more than 3 years, indexation could actually help me save 50% of my tax outgo. So in my real opinion, I think timing debt markets is even difficult than equities market, especially in my opinion for the retail investors. Tax is going to be a big dagger for most investors to try and do anything. So unless your goal is close by and you are actually going to need this money, try and do something. Otherwise, completely avoid trying to actively time the market, which I believe most of us will not be able to do. Neeraj, to answer the second question, look, in my opinion, there are 2-3 things that an investor can do, right? First, of course, having said that, and Mr. Bagla also rightly pointed out, I think if you try and keep your average maturities, and I'm specifically not using modified duration as a term, but you try and keep your average maturities as low as possible, you will really be able to take advantage of the reinvestment. So if you invest in a liquid fund or an ultra short-term fund kind of a fund, which is investing in CPCDs for 2 months, 3 months, at the end of this 2 months, 3 months, when the rates go up, again, when it gets reinvested, your fund will be able to make more better investments.
Kirtan, sorry, you are preempting my follow for future question, which is what an investor can do afresh. What about somebody who already has the paper? You are saying don't do anything.
Don't do anything in my opinion.
Okay, so that is part one. Okay, I'm sorry, Kirtan. I'll come to what an investor should do for the new investments in just a moment, but I just wanted to get the first part of the question answered, because almost everybody who watches these shows has some investments already. So for the newer investment, slightly easier, but the difficult or the tricky part is what to do with stuff like this, wherein everybody on every media house is saying that, oh, rates are going to go up, so try and manage your portfolios accordingly. Mr. Bagla, the email that we got from you suggested that retail should be advised to break the fixed income part of the portfolio into a mix of many different kinds of funds. I know you briefly alluded to that. Can you elaborate a bit on that, sir? It will help everyone.
No, since see, it's basically the same spirit in which Kirtan is saying that it's difficult to time the market, and the volatilities have increased, and there has been instances of central bank puts where, at the instance of any possible disruption to the economy, central banks step in and their balance sheets keep growing, right? So in that scenario, I would say that probably break your investments into various categories. And if you can do that as per your investment horizon, that would be great. Otherwise, you invest partly into corporate bond fund, partly into banking and PSU debt fund because the quality is typically good. Have some money in the money market or liquid funds for liquidity management. Probably, take some duration call as well. Although my personal sense at this point of time is that, uh, given the observation that I have that typically the 10-year yield in India trades at about 250 basis points higher than expected inflation, then the fair value should be closer towards 7.5. I would still say that, put 10% lower your allocation, but put 10% in duration funds, as one never knows and one cannot time the market. And once yields go up, then you sort of, rebalance the portfolio. So besides credit funds, I would suggest that, in every bucket, maturity bucket, you sort of split your investment as per your preference.
Okay, but diversify, essentially. That's what Mr.
Yes.
Bagla seems to be suggesting. Now, Kirtan, one, do you agree? And it's okay to disagree, by the way. So that is part one. And then follow that up, Kirtan, with what would the modus operandi be? I mean, one of your clients is coming to you and asking you fresh money to be put to work on the debt side. What would you advise?
So Neeraj, I have actually three things to discuss here. Of course, I don't want to go on this very basic saying, keep money at the lower end of the curve. I think all of us have discussed that. But I think there are three ways I will look at this particular situation. The first way is keeping it very plain and simple, like you would do in a fixed deposit. If you really want to deploy this cash for 3 years, try and find a fund which will have a 3 years of average maturity, right? Like you would do in a fixed deposit. If you want to invest for 3 years, you try and do a 3-year fixed deposit. I think this will make sure that though in the near term, if there is volatility, at the end of the day, you are okay to ride the volatility curve because you're okay to invest for 3 years. So first, the simplest way to do it, try and match your investment horizon with the average maturity of the fund. Second is more asset allocation based approach, where I'm saying try and split this fixed income investment into 3 buckets. First, do liquidity. Second, do core. And third, do satellite, right? Or tactical, whichever way you would want to put that as. So let's say have 10% of your money or 15% of your money in liquid funds or ultra short-term funds or money market funds. That will largely take care of the liquidity that you would need as and when. Depending on your risk profile, right? Create the 70% of core bucket, right? So let's say if you are conservative, try and keep that in short-term debt funds. Let's say you are moderate, you try and do banking PSU, corporate bond funds. Let's say you are aggressive, right? You can do a combination of medium-term funds plus credit, right? Depending on your risk profile, that's 70%. And the remaining 20% is satellite or more aggressive, right? Having a small part of your portfolio which is slightly aggressive than your core and liquid is okay. And that's how an asset allocation is typically done. So depending on your risk profile, you choose what part of your portfolio do you want to keep for this 20%. Let's say, so if I'm conservative and I have kept 10% in liquid, 70% in short-term debt fund, right? So the remaining 20% can probably go as a combination of 10% to medium term and 10% to credit risk. Depends again. But largely this will, like Mr. Bagla also said, this will diversify the portfolio, and in my opinion, this will be a well-diversified portfolio. The third is more tactical in nature, Neeraj. For somebody who understands fixed income or believes that the advisor understands and he will advise it correctly. I think if you look at historical data points over the last 20 years, you would see that in every rising interest rate market, barbell as a strategy is really worked out well for investors. What's barbell? To keep it very simple, you've got 100 rupees to invest, put 50 rupees at the lower end of the curve and put 50 rupees at the higher end of the curve, right? This strategy has almost always worked in a rising interest rate environment, but you should only do this with at least a 3-year investment horizon in mind, or else you will get caught on the wrong end. So I think depending on what your objective is while you are listening to this interview, I think either of the three things that I spoke to you of may be of help.
Yeah. So either you've listened to this, if you're not listened to this, or if you're not understanding, we'll write a story around this and you will get a sense of that as well later on. Now, after we thank Mr. Bagla, Kirtan, we would request you for maybe some recommendations, and they don't necessarily be in a particular order, but just a few names so that people can understand which are the well-managed ones. But before we do that, Mr. Bagla, I would want to ask you a question that a typical viewer would ask or wonder, that the way these shows are being done and everybody's talking about what should an investor do, a fund manager within his mandate or within her mandate would also be doing things in order to mitigate the risks as much as possible. What is it that fund managers are doing? I mean, there is this whole concept of active fund management. It could be interpreted in various ways. Can you talk a bit about that?
Most fund managers anticipating rapid hikes in interest rates would have reduced their maturities substantially. So, for example, in a short-term fund, if the mandate is to remain between a duration of 1 to 3 years, most fund managers would be anywhere closer to 1.5 to 1.75. So they have reduced risk to quite an extent. So at the active fund managers, if one can actively manage things, then of course a lot of alpha can be generated. And if interest rates are on their way down, then a lot of returns, double-digit returns, can also come from income funds and gilt funds. But that is not to be right now. But to your point, most investors, investment managers, being active fund managers, have reduced the duration and improved the credit quality of their funds in order to improve the liquidity situation, as well as reduce the interest rate risk component of the funds that they are investing.
Okay. Mr. Bagla, really appreciate you taking the time out and joining us and giving us the synopsis and your wisdom. Thank you so much. And I'm sure it will be helpful to a bunch of people who are watching this or reading about this over the weekend.
I hope so. Otherwise, one can reach me on Twitter for any direct queries, or get onto your channel. And thanks a lot for inviting me.
The pleasure is ours. But yeah, that is a useful suggestion, viewers. You can reach to him directly on Twitter. Do search for him, and maybe if he finds the time, he can maybe answer some of those queries as well. Thanks, Mr. Bagla, for joining in today.
Thank you so much.
The pleasure is ours. Well, Kirtan, just one quick follow-up to you as well. So you obviously, we've seen what is it that an individual investor ideally should do. Now, within these buckets, are there funds that you believe, not necessarily in a particular pecking order, but are there funds that you believe an investor could ideally look at from a separate house or a different category, what have you, or a mix of the two?
Neeraj, in my opinion, one very important thing that investors should definitely keep in mind is do not try and invest in debt funds with lower AUM, because they are typically the ones who are going to find it extremely difficult if there is going to be a liquidity crunch tomorrow. And we've seen this happening multiple times in the past. So while I may give you a couple of names, I might not be able to spell out the logic as to why I'm doing, but this is one very simple but yet extremely important data point, I think, which retail investors should definitely keep in mind. Now, so let's say if you talk about at the longer end of the curve, because I said you could do a barbell, 50% at the lower end and 50% at the higher end. At the higher end, you can look at Aditya Birla Government Security Fund. That's one fund that we like. We also spoke about medium-term fund in the tactical asset allocation. You can look at SBI Magnum medium duration. We like that fund. At the shorter end of the curve, you can look at ICICI short term. Credit, very honestly, though this is, I mean, a lot of people on the show might not really discuss about this. But for the next 2-3 years, I think I am personally very gung-ho about credit. I think on the debt space, with somebody who understands and is willing to take that slight risk, credit is a very good opportunity today. An HDFC or an ICICI credit makes a lot of sense to me. So yeah, a couple of funds. Maybe I hope that helps.
It does, Kirtan. And thank you so much for joining us today and giving us your recommendations and your views. Really appreciate your time.
Thank you so much for having me on the show.
It was ours, and viewers, thanks for tuning in.